Hey, Bowtie Nation, Joseph Hogue here with a very special video, a collaboration I've wanted to do for a long time with one of my favorite YouTubers out there, and really what could be your master list of stocks to buy for 2026. On with us today is Brian from Business with Brian, the BWB channel over there on YouTube. Welcome, Brian. Hey, why don't you just tell us a little bit about yourself?
Absolutely. I appreciate it. So for me personally, I not only do I have a similar haircut to you, I have a similar channel, which I started a couple of years ago out of necessity because I was a little bored because I retired 6 years ago at 46, where I was lucky enough to work for big companies like Amazon and Target. But I think a big takeaway is I started late in life, meaning I served in the military, then I went to college. I didn't even start my career until I was 31. And in 15 years, I managed to be completely broke out of college and somehow become a multimillionaire so I could retire young. And the whole point is anyone can do it. It just takes a little conviction and investing in yourself to learn how to invest. So that's me in a nutshell.
Excellent. And yeah, it seems like very similar, kind of eerily similar life experiences. I actually, military, then college, a lot of life experiences that didn't turn out quite how we thought they would. I started investing in 1999 and made all the mistakes several times over, 99, 2000, 2008, and had to learn from those lessons. So yeah, that's why I think I kind of like your channel so much more than a lot of the other channels there on YouTube, just kind of those shared experiences. Well, let's get started though, because putting together this video, the idea for this video, got a lot of great questions there in the community tab on the channel. But one idea stuck out to me in particular from Mark Younger. That was creating a must-buy list of stocks for 2026. And Mark wanted to see the AI stocks, but we're going to broaden that out here. One that I think we can get a little bit of drama here, because basically the idea is we got to pick 5 stocks that both of us like, that both of us agree on, that are your must-buy stocks for this year. So here's how it's going to work. We're each going to take turns proposing a stock, one of our favorite stocks there. The other one's going to be able to agree or disagree with that. We'll continue on through that until we find 5 stocks that we're both buying, 5 stocks that are must buys right now. Before we get started though, we're planning another collab on Brian's channel. So if you have any stocks you want us to talk about, questions you want for myself or Brian, go ahead and let us know that in the comments below. Brian, why don't you go ahead and get us started with your first stock?
Okay, no pressure. I have a list. I have a sheet of papers, like 10 stocks, in hopes that we don't have to go through all of them. But I'm hoping the first one is a softball pitch. It's going to be Broadcom. And I'm going to give you a quick high level as far as what it is, if you don't know. So they design a lot of specialized chips. They're not an actual manufacturer, but they also help with custom AI accelerators for big hyperscalers. So they have a lot of potential, a lot of bandwidth, and very high margins. In addition to that, they had acquired VMware a couple years ago, which gives them, it's a virtualized cloud environment. So this is something that they've acquired a couple of years ago, and it's giving them some big boosts in their margins, which is great to see in a short-term acquisition. For me, their cash growth is awesome. So they're sitting at 16 billion in their cash position, and it's up 73% year over year. So clearly they're really taking it in. And then also their efficiency, they're sitting at over 67% margins right now. And that's a scenario where that VMware has bumped them up something like 13 points year over year. So that's really been accretive to their business, which I love to see. When it comes to the rule of 40, they're crushing it. Then also, as far as undervalue, this is one of the things that I really love. Their PEG ratio is at a 0.98. Something that I love to see when it's under a 1. It's never a sure thing, but it's a nice indicator in my mind. And then also, their quarterly earnings growth is up 188%. So from my perspective, I think they're a softball pitch. And then also, they had a big correction in December. Like they dipped like 21%. That doesn't necessarily mean right now is the perfect moment, but it's not a bad moment. I think that they have a long trajectory, medium, long term. I think they're great.
Sure. Yeah. And I would have to agree with this one. If you believe the AI theme is going to continue, and of course, I do think that that's going to continue, that AI data center build out, then what we've been doing on the channel is looking at, that supply chain of everything that goes into the data center and who competes in each part. And I don't think, maybe other than Nvidia, nobody else has as many inputs into a data center as Broadcom. They've got the accelerators, the chips themselves, the networking. As you said, I think the VMware acquisition is just starting to pay off in those higher margins. So yeah, great stock. I would definitely agree with that one. Going to get started with our second stock here. And all you out there in the nation know cybersecurity is probably, if not maybe one of the top picks or the top segments for me, top long-term growth themes. It is the one area of an IT spending budget, enterprise spending budget that cannot be cut. I think maybe upwards of 2/3 of large enterprises got hit by ransomware attacks over the last year or two. Those attacks have cost an average of $5 million each. So, companies are having to progressively spend more and more protecting their enterprises, their technologies, and cybersecurity is right there with it. Overall, cybersecurity spending is about 12% pace annual growth. But if you look at specific segments of that, cloud 18% year-over-year growth, SASE 16%. So you can find the companies that are dominating in specific segments that are growing even faster. And I think that's where Palo Alto Networks comes in, ticker PANW. I like this one. It's not just the largest by market cap. It has the financial power to really dominate a lot of these different segments, these growth segments, right? So it's in cloud, it's in SASE, really the driving force, dominant player in some of those. Next to maybe CrowdStrike, maybe has a competitive advantage as well there. But very, very well placed in agentic as well. And really the only company, because of its size, really, that is able to participate in each of the segments within that. Just made a big acquisition this last year in in identity management. So they'll be expanding their reach into that as well. Great operating margin on this one when a lot of the other companies in cybersecurity are operating at a loss. A lot of companies, CrowdStrike, another one, Zscaler, one of the ones I hold, operating margins or operating losses because they're spending so heavily on R&D and on growth and operational costs. Palo Alto is more of a balanced approach. It's got a 12% operating margin, so still profitable there, and actually the second least expensive on a price to earnings and price to earnings adjusted for growth basis. So this is one that it's maybe not the growth pick in cybersecurity. For that, I'd maybe go with CrowdStrike or another one, but it is definitely the growth at a reasonable price for a great sector.
From my point of view, I mean, I'm not going to argue this one much just because it's one that I really stand behind. It's one that I have in my own portfolio. As you mentioned it, so I quickly looked on my computer so I could look up what it was and like some of their financials just so I can answer it somewhat knowledgeably, just so I'm not an idiot. Their PE ratio is crazy high, but all the items that you mentioned as far as cybersecurity is, I think it's infancy as regards to companies are going to need this more than ever. And I don't see it slowing down anytime soon because the evolution of AI, as we know, or even like this technology in general, like hardware spikes really high, software starts to kick in a little bit later, similar to how it did with cell phones. I think that like the green pastures are still coming up for companies like this, and Palo Alto, I think it's a solid choice. No concerns from my point of view.
Excellent. Great. Third stock then.
Third stock. All right. Oh boy. So my third choice is Nebius Group, which might be a little polarizing. And if you don't know who they are, it's an Amsterdam-based company. It's AI infrastructure. They provide cloud services and GPU computing infrastructure. And one of the things that I really like about them is they have a very strong cloud partnership with Nvidia, where they're actually getting specific access to their new Vera Rubin, which they are pushing hard on that. And I feel like that is going to have a ton of potential. Their balance sheet strength, they're maintaining $2.4 billion in cash position. Let's see, their debt is super low. It's only $49 million. So their debt to cash ratio it's under 2%. So they're doing really well as far as the financials. The revenue trajectory, they're projected to be up 520% this year. So they're on a strong path for that respects. Let's see, I'm trying to look at other things. Margins are also 60% margins. They're doing really solid. Let's see, valuation gap. I really have nothing else more to add. I just see them as playing in a space that's really strong. The only concern is it's also not exactly a moat. They have so much competition that I recognize they do have risk. But overall, I feel like they're set up for hopefully long term success. And then I'm going to volley it to you and find out what your thoughts are.
Sure. Actually, I think this is going to be the first drama. The first one I got to disagree on, and it's just because a couple of points. We're both old enough. We remember back in the heady days of the '90s, the '80s and the '90s, and the leasing models that came about. A lot of these companies basically were doing the same thing. So Nebius, CoreWeave, in the same boat here, leasing out their cloud and data center services. Well, back in the day, right? They had these companies leasing out these mainframes and the computers when IBM was first coming up, really being used on the enterprise level. And of course, they were really beholden to IBM's upgrade cycle, right? And so anytime IBM would come out with new products or new tech, then these companies would be just flooded with old obsolete technology that they really couldn't sell. They couldn't get the resale value out of it, not nearly what they had predicted and sold. So it ended up being obviously very high debt and actually some scams. Not saying that this is anything like Nebius or CoreWeave, but a lot of those they started filling it up with cooked balance sheets and cooked books, things like that. It's one thing that kind of worries me about these lessee models with the infrastructure, because as we know, a lot of the hyperscalers, the Amazon, the Microsoft, they're all building their own data centers. They just don't have enough capacity just yet. So that's why they're running to these leasing model companies, CoreWeave and Nebius. So my worry is that even if AI continues to build out those data centers, eventually these hyperscalers, they're going to have all the capacity they want or need, and they're going to drop Nebius like a bad habit. I would worry about I think it's the debt is really exploding over the last maybe quarter or so. No, I'm just looking at Yahoo Finance numbers, and it looks like just this last quarter, it looks like they've got non-current liabilities of 5 billion. And that's quite a bit up from last year, from December 2024, they had 30 million, 30 million. So that might be where your debt's coming from. Maybe the numbers here on Yahoo Finance are wrong, but it does look like, because they don't have that cash flow generation that the big hyperscalers do, then they're taking on a lot of debt to obviously to buy up those, and build out that infrastructure to be able to lease it out. Of course, higher risk means higher return. If they can keep that data center compute capacity growing, then they're going to be the stocks to own. I just worry that it's history doesn't repeat, but it often rhymes, and I'm worried that we're going to find a day when Nvidia comes out with a new chip and they have to buy all these new chips, and their debt load just can't take it. So I would disagree on that one, but it's still one that I think if you like the story, if you think AI is going to grow anything like what we did last year, then Nebius would be the one to watch. You look at what did it do last year as far as returns. I think probably 178% returns over
It's
the
high.
last year. So that's something that you don't want to completely ignore. You just want to watch.
It's a fair point. The leasing model, it's, to your point, high risk, high reward, and it's an easy one to drop for big companies. I get it.
So next stock, I'm gonna put out Walmart there, kind of a different in something other than tech. I think it's a category killer, which is what you always want to look for. Those really dominant in their spaces, category killer in retail with really so many levers to pull there. Okay, the food tariffs that are coming off. President Trump said he was going to bring down some of the food tariffs that he had implied, and I think what people don't know is that's going to lower the cost for a retailer or distributor like Walmart, but they're not necessarily going to pull their prices down that they raised for those tariffs. So I think you're going to see profit margins go up as those tariffs come down, their input costs come down, but maybe they keep those prices a little bit higher. They always say that inflation goes up on the escalator, or up on the elevator, and down on the escalator, so down in steps. And I think that's what we're going to see, and I think we're going to see it reflected in Walmart profit margins. They made the Vizio acquisition, so all the Vizio TVs that you see sold in Walmart, that's for a very strategic reason, because all those Vizio TVs are going to start showing Walmart ads on them. Walmart is it's just like Amazon. Its ad segment is probably its fastest growing by revenue segment there, really moving into advertising and that. GPT coming up with the ads launch there on OpenAI's GPT model, going to be working with Walmart. So I think that's a big lever there. One of the biggest ones that you really don't notice, even if you shop at Walmart like I do, some of their private brands. Okay, you next time you go to Walmart, if you do, go to look for Better Goods, the Great Value brand, their Mainstay brand, their Equate brand. These are all over, and what we've seen over the last year or two, a lot of the a lot of the consumer staples companies, Johnson Johnson, you've got Kraft Heinz, Campbell's, been really suffering because Walmart is basically moving into their goods. Okay, it's the same Amazon Basics playbook, right? Amazon let people sell stuff on their site and then kind of reverse engineered those products, put it under the Amazon Basics label, and took a lot of that market share. I think Walmart's doing that over the last year, and it's really reflected in the share price. They're going to keep on doing it. You're going to see all those Walmart brands right at eye level at the stores and taking that market share.
Okay, my point of view, having worked in retail for the majority of my life, I don't love retail stocks. However, if you're going to own one, Walmart is pretty solid. And funny story, one of my good friends is the VP over private label at Walmart. So he's going to love the fact that you made that recommendation, that reference. He's going to love it. But your like your formation, your framework, as far as all the goodness that I think is kind of coming forward, as far as, with the tariffs potentially being pulled, or even for the fact that we're going to be anniversarying them, you're going to start seeing a lot of those numbers compress, which whether or not it helps people or not, it's still the story, and it's going to reflect well. Their online presence, I don't know the numbers off the top of my head, but I know that they're growing double digits, very strong, and it's in its infancy, in my opinion, just because it has so much runway. In fact, I even have a business on there, which I kind of test on the side just to kind of keep up to date in how they're doing. They're so much easier to work with than Amazon. Trust me, from my perspective. And you're right. I feel like they're going to continue to just be that powerhouse. Are they going to blow the doors open like a tech stock? No. But in the reality is, if you're going to have a nice, solid growth trajectory with a stock, this one's it. Like I'm not going to balk at this one at all.
Excellent. Okay, next stock.
My next one. Okay. This is going to be hopefully another softball. I'm throwing out Amazon, and I don't often refer to Amazon in a bright light just because they are so up and down. So if you look at their patterns over time, they have a tendency to spike, and then they'll plateau for a couple of years, then they'll spike and plateau, and they keep doing this cycle. And we're kind of at that point where we've been at the plateau for a couple of years. It's about ready for that next boost. But there's signals that kind of drive that. So one of them happens to be revenue with regards to AWS. AWS is kind of in a U turn right now. Literally, it was declining, and then suddenly it has bumped up. So it's like double digits again. So it's like 20%. It was down in the teens there for a while. So now it's starting to re-accelerate because of AI, and people are starting to figure out that, hey, they need these hyperscalers for these things. I also work with a lot of big companies, and all of them talked last year about these issues. As far as AI, they tried to do them in-house. They recognize they can't do it well. So now they're leaning back onto the big hyperscalers to leverage their tools. So I think like the big companies, especially Amazon, are going to have so much potential and growth from this that I believe they're just going to keep driving it up and up. They've also, their operating leverage, let's see. So their operating income went from 12 billion in 2022 to 69 billion in 2024. Sorry. So that was just a massive increase in a short amount of time, because in the past they tried to pay for their infrastructure strictly, from dropping their total cash flow, even though they didn't have it. Now they have the cash. So it's going to greatly improve their scenario. I don't love that they're doing layoffs, but overall, I think that they have a lot of upside because they're doing all the things, and they're aggressive when it comes to the balance sheets and free cash flow. Like, I lived it. I breathed it. Every quarterly earnings report, I hated it, but they are hardcore when it comes to their financials. I think they're good.
Okay. Yeah. Excellent. I think, Amazon's one that I missed out on for so long because, the cheap asset in me always wanted the cheaper stock, the growth, but growth at a reasonable price. And Amazon was one that, if you put it on a price to earnings basis, it never made sense because it was so expensive, because they were reinvesting all of their sales, everything back into growth. And it shows in the stock price, it shows in their growth. They grew into that. I think now, over the last few years, we've seen them kind of shift a little bit more towards profitability, and they're great. It's another category killer. They're in retail. They are the leader in e-commerce, the leader in cloud. Just like Walmart, I think advertising again is probably their fastest growing segment by revenue.
It is.
So they're doing very well, and yeah, I'm stocking up on Amazon on any dips here. So next one, SoundHound, going back into the AI theme here. One of my favorite themes for the last year and this year, but SoundHound really got to be my favorite next generation AI, right? Because it's a AI. Artificial intelligence voice assistant, right? So they're putting that artificial intelligence to work with voice assistants that in your car, at the drive-through. Then they've really got a competitive advantage in kind of a unique speech to meaning program, instead of a lot of other companies are having to go speech to text to meaning. So it slows it down a little bit with SoundHound. That speech to meaning directly, you get a little bit more real world speed and accuracy there. They are really the leading voice assistant there in their car and drive-throughs. They've already signed up partnerships with Hyundai, Stellantis, Pandora, a lot of the car makers, a lot of the drive-throughs. They've got drive-throughs at White Castle, as well as Krispy Kreme drive-throughs. They're trying to automate those with their AI. So I think it's a really innovative company. Obviously, risk abound with this. It is a small company, but if you look at just the potential for this $160 billion market potential in those voice assistants, even at a 5% share of that market, that's not something like $8 billion in revenue, annual revenue, just pales their current $167 million in current sales. So you've got the potential for many multiples on top of this stock if they can keep that dominance and really take that competitive advantage into this, what is a next generation part of AI. So definitely one where you're going to have patience for, because that use case for AI is still maybe a year or more out. But when it gets there, I think SoundHound is going to be the stock to have.
That is so interesting. So that I did not expect that to surface. So I had to quickly pull it up on my screen. SoundHound, I liked them earlier on. They're not my favorite today, only because I think there's good solid growth choices that aren't as risky. Plus the moat for them, I feel like it is going to be infringed upon so much. I haven't seen enough in their technology that tells me that they're going to stay light years ahead of everyone. Yes, they have these relationships with the big companies. I know that CES, they had some big announcements. But when I look at the fact that they're just burning through cash flow, and like their price to sales ratio is really, really high, they're burning through the cash. So my concern is, like, they've been negative for a while, and like it's a tipping point, and it looks like they've been at that tipping point for a while where they're just on the verge of breaking through. I feel like if they break through, the stock could have some strong momentum, but I think it's on a weak foundation, in the fact that I'm concerned about the fact that everyone could probably infringe upon it. So that's kind of my approach on that. I think there's just better options that we could probably get more safer returns. That I might get just hounded in the comments on this one, but this one's not my favorite.
Sure. No, definitely one of the riskier picks on my list. Sounds like it's a no there on the agreement. Yeah, it's one of those that, like all small companies and in tech, it's a bad cash position. 270 million or 270 million ending cash position to cover 111 million negative free cash burn. So they will likely need to raise cash in the future. So we'll drop that one. Next one, I believe we're looking for number 5 here.
I'm kind of blushing. I feel almost embarrassed for like saying I'm not a huge fan of one of your stocks, but hey, that's the point, right? I think the guy's comment when he said it, he's like, it's like the Highlander games. Whoever comes out on top will win them all. So it was a fantastic comment. My next one, I feel like is just an easy breeze. I'm throwing it out there. Nvidia. I think we'd be a joke not to say it. I know that so many people say it's so expensive. It's so expensive. It's at the top. The valuations are just out of this world. But the reality is, they have 90% of the share in the data center GPUs for a reason, because they are the best. And I don't see them falling anytime soon. Their biggest risk is whether or not they have supply chain issues, or regulation challenges, which clearly China has now been opened up on the H200s. That is opening up a ton more sales for them. So I think they're in a really good position. I think everyone knows who they are, so I'm not going to really touch on that, but I'm just going to hit on some of the top numbers as far as, let's see, the Vera Rubin, which is the one that's coming out. This one is going to get 5 times inference performance, 3.5 training performance, and then also the token costs are going down 1/10 by using this system. I don't know what the difference in cost is between the Vera Rubin and their last iteration, but I'm guessing it's going to be a pretty expensive investment. But the payoff, I think a lot of people are just going to jump on it, because this is turning into it's an arms race when it comes to AI. And I think that everyone is investing so heavily, and I think that they're going to start asking for subsidies or some leeway as far as how they can get extra push to make sure this kind of goes even further. Let's see. One thing that I love is their AI enterprise software. Like, they're one of the fastest growing areas for them. It's at 2 billion in annual pace right now. And it's just getting started. I feel like that's going to just be a new number that's just going to keep growing, and that's going to help their margins, because that's, I think, easy money. Plus, they're scaling. I mean, their CUDA software, they're driving what everyone uses to build all of these, systems on top of their data center systems that they're offering, on top of quantum computing. They also offer the software for that. So they're touching on all these areas, plus robotics. You add all these together, they have a good 2 years of solid growth. I'm not betting against the house on this one at all.
Sure, definitely. And, like Amazon, I missed out on Nvidia for so long until I just held my nose and jumped in, because you see these price to earnings, price to sales numbers, and it kind of scares you off. But you always have to adjust that by their growth, and their growth is just spectacular here, because they are another category killer in so many things. And as you pointed out, I love the fact that they're moving from GPUs to all these other segments, enterprise software, and really keeping those advantages. If you're ever looking for a company with a competitive advantage that is going to keep it growing against its peers, keep taking that market share, you just look at those margins, right? Nvidia with an operating margin of 63% versus AMD with 10% operating margin. Okay, so Nvidia converting $63 out of every $100 in sales into operating profits. AMD is down here at $10. There is a reason for that. Okay, there is a reason, because Nvidia can basically charge whatever it wants for its GPUs, because they are in so high demand. It can charge whatever it wants. It's got that power over its suppliers as well as there in its buyers, and it can convert that into operating profits like Amazon or AMD just cannot. We've done really well on AMD over the last year, but you can't deny that Nvidia is the chip maker to own. All right, so hey, it looks like we've got 5 stocks though. We've got wrapping up with Broadcom, ticker AVGO, Palo Alto Networks, PANW, Walmart, ticker WMT, Amazon, AMZN, and Nvidia, ticker NVDA. First 5 stocks there. Did talk about in Nebius, ticker NBIS, and SoundHound AI. Came to a little bit of blows on those two, but I ain't mad at you, because we got some great stocks here. Brian, where can investors find you, and how do you want to connect with them?
For me, it's just on Business with Brian on YouTube, and quite honestly, I love doing this. I had a stack of more to go just in case. I didn't know we were going to go. I gotta say, I'm shocked you didn't mention Supermicro.
I thought it was too contentious. I basically I wanted to save for the ones that I knew I could get across the plate, right?
I love it. I love it.
Supermicro, it's a good stock, and we've got all the time in the world. We talk about Supermicro. I think it's if like a lot of those stocks in that AI space, like SoundHound, like Nebius, if you do believe that the AI theme is going to keep going, then Supermicro is just a no brainer. It's hard to say that a company with 22%, upwards of 30% of the AI server space. Okay, so again, looking in that supply chain for that data center build out and that AI infrastructure build out servers, you've got all these GPUs sitting around from Nvidia. They got to be put in something. They're put in a server, and SMCI is the leader in that server space. So you've got 30% of the market share there, 65% revenue growth this year, just insane revenue growth. And yeah, profitability is a problem, as pointed out by Goldman Sachs, I think last couple of weeks ago with their sell rating. But again, I look at that as something like an Amazon, a decade or so back. They are spending so heavily on growth to get that 65% revenue sales growth to keep that market share and even increase that market share in servers, that they're sacrificing a little bit of profitability. Profitability comes in the future. It is hard to deny this stock on a valuation basis. Trading something like 0.5 times, 0.4 times on a price to this year's expected sales basis. Okay, so very, very deep value. We've seen it go up to 60 before over the last year, come down to 30, come down into the 20s even. It's not a stock
It's
for the faint-hearted, but it is a
it's
stock for
definitely
smart
discounted
spacious.
right now. I mean,
Yeah.
it's opening itself up for opportunity. I'm okay with those sell ratings every once in a while. It gives us opportunities to jump in when the moment's right.
Awesome. All right. Well, we're going to be doing a lot more of these because I know we've got a lot more questions for Brian there. We're going to be doing another video on his channel as well. So make sure you check out Brian's channel, Business with Brian. I'll link to that there in the description below. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.